something extraordinary happened on January 23, 2025. While most Americans were distracted by political theater, President Trump quietly signed an executive order that fundamentally alters the trajectory of the United States dollar. This wasn't a routine policy adjustment. This was the activation sequence for the largest wealth transfer in modern history. The order establishes what they're calling a strategic Bitcoin reserve, positioning digital currency alongside oil in America's emergency stockpiles. The official story: keeping pace with China in the crypto race, maintaining technological leadership, protecting innovation. Standard political messaging that sounds reasonable, even forward-thinking. But scan past the public relations language and the real architecture emerges. This executive order is the implementation phase of a debt elimination strategy that's been decades in development. The same strategy deployed in 1933 when the government faced an impossible debt burden. The same playbook used by every overextended government throughout history when they reached the mathematical point of no return. That point? We're already there. America's outstanding obligations have crossed $38 trillion, a figure so astronomical that the human mind struggles to process its scale. To understand the magnitude, consider this: that sum exceeds the entire planet's economic output from just 20 years ago, and unlike previous debt cycles, there's no feasible path to repayment through conventional means. What's coming isn't a default. Defaults destroy government credibility permanently, ending a nation's ability to borrow. What's coming is something more elegant, more legally defensible, and far more devastating to ordinary citizens: a monetary reset executed through strategic asset revaluation. Before we dissect the current strategy, you need to understand one fundamental difference between government debt and personal debt. When your household finances spiral out of control, your options are brutally simple: earn more, spend less, sell assets, or declare bankruptcy. You operate within a system where the rules are fixed. Governments operate differently. Sovereign nations that issue their own currency possess a tool unavailable to citizens. They control the measuring stick itself. They don't just participate in the monetary system, they define it. And when debt becomes mathematically unpayable, they can rewrite the equations. This isn't about printing currency in the traditional sense, though that's certainly part of the toolkit. The more sophisticated approach involves asset revaluation on government balance sheets. Here's how it functions. Take an asset the government already owns. Declare that asset is now worth 10 times its previous value. And suddenly your balance sheet looks dramatically healthier. Your debt hasn't changed in nominal terms, but relative to your newly valued assets, it's effectively shrunk. The genius of this approach is its legal cover. You're not technically defaulting on obligations. You're not explicitly confiscating private wealth. You're simply adjusting the official valuation of strategic reserves, a power governments have claimed throughout monetary history. It appears technical, bureaucratic, almost boring, which is precisely why it works. But make no mistake about the underlying reality. When the government revalues gold from current levels around $4,000 to $20,000 per ounce, they're not making the gold more valuable. They're making the dollar less valuable. And every dollar you hold, every bond you own, every fixed income asset in your portfolio loses purchasing power proportionally. The wealth doesn't vanish, transfers from private citizens to government balance sheets. The 1933 blueprint: how Roosevelt reset the dollar. Let's examine the historical template, because this exact strategy has already been deployed on American soil. In 1933, the United States faced an economic catastrophe. The Great Depression had eviscerated the economy. Banks were collapsing. Unemployment was devastating communities. And critically, the government's debt burden relative to economic output was climbing toward 40%, a level considered catastrophic at the time. The problem was structural. America operated on a gold standard. The dollar was defined as 1/20th of an ounce of gold. For 54 years, since 1879, an ounce of gold had been priced at $20.67. This price was legally fixed. Your paper currency was literally a claim ticket for physical gold held in government vaults. But this created a constraint. The government couldn't simply print dollars to pay debts because every dollar had to be backed by gold. And they were running out of gold as panicked citizens exchanged paper for metal. The system was collapsing. President Franklin Roosevelt's solution was both brilliant and ruthless. First, he criminalized private gold ownership. Executive Order 6102, issued in 1933, made it illegal for American citizens to hold gold coins, gold bullion, or gold certificates. Citizens were ordered to surrender their gold to the Federal Reserve in exchange for paper dollars. At the official price of $20.67 per ounce, most Americans complied. They exchanged their hard assets for government paper, trusting that the official price was fair and the dollars would maintain value. This was their first mistake. Once the government had consolidated most of the nation's gold supply, Roosevelt executed the second phase. In 1934, he announced a new official gold price, $35 per ounce, not $21, not $25. $35, 69% increase overnight through administrative decree. Look at what this accomplished from the government's perspective. They had confiscated gold at $20.67 per ounce. At that price, the nation's gold reserves were valued at approximately $4 billion. After revaluation to $35 per ounce, those identical reserves were suddenly worth $6.8 billion on government books. They had manufactured $2.8 billion in balance sheet value through accounting adjustment. But the devastation for ordinary citizens went deeper. The debt-to-GDP ratio, which had been 40%, began falling dramatically. Not because the economy recovered, it didn't, not for years. The ratio fell because the inflation generated by devaluation increased nominal GDP while eroding the real value of debt. Within 5 years, the debt-to-GDP ratio had dropped to 25%. Meanwhile, Americans who had surrendered their gold at $20.67 watched the metal they had owned get officially revalued to $35, a profit they would never see because reclaiming gold was now illegal. They were locked into holding dollars that had just lost 40% of their purchasing power. Not immediately, not obviously, but through the inflation that followed over the subsequent decade. This is the architecture. Consolidate the hard asset. Revalue it upward. Create paper profits for the government. Devalue the currency for everyone else. Transfer wealth from private citizens to public balance sheets. All technically legal. All justified as emergency economic policy. And it's happening again. Right now. The current trap, unpayable mathematics, let's confront the numbers that make this strategy inevitable. America's federal debt now stands at $38 trillion. The debt-to-GDP ratio has reached approximately 123 to 125%, higher than any point in U.S. history except the peak of World War II. But unlike the war years, when debt could be justified as temporary emergency spending with a defined endpoint, today's debt has no finish line. It only grows. The annual interest payment on this debt currently consumes approaching $1 trillion. The fiscal year 2025 figure was $970 billion. Read that again. Nearly $1 trillion paid yearly just for the privilege of maintaining existing debt, not reducing it. This exceeds the Pentagon's budget. It exceeds Medicare spending. Only Social Security commands more federal resources, and these interest costs are calculated at relatively moderate rates. Federal Reserve policy has kept borrowing costs elevated to combat inflation. If these rates persist, and given structural inflation pressures, interest payments will reach $1.8 trillion annually by the mid-2030s. That represents 3.2% of GDP in 2026, climbing toward record levels. Not building infrastructure, not funding programs, just paying interest on money already spent. This is mathematically unsustainable, not politically unsustainable, not concerning to economists, literally impossible to maintain through conventional fiscal policy. Let's examine the supposed alternatives. Can we tax our way out? No. Even if you confiscated 100% of billionaire wealth, every dollar held by every billionaire in America, you'd collect roughly $5 trillion. That covers 13% of current debt and does nothing about annual deficits that continue adding another trillion plus yearly. And this is a one-time extraction. You can only confiscate that wealth once. Meanwhile, you've destroyed the entire investor class, crashed the economy, and eliminated the tax base for future years. Can we grow our way out? No. Economic growth would need to consistently exceed debt growth for decades. But debt is compounding at rates higher than GDP growth. The Congressional Budget Office projects this divergence widening further. Even optimistic scenarios show debt growing faster than the economy's ability to produce. Can we cut spending? Theoretically possible, practically impossible. mandatory spending, Social Security, Medicare, Medicaid, interest on debt, consumes roughly 70% of the federal budget. These programs are politically untouchable. Cutting them triggers electoral suicide. Discretionary spending, even if eliminated entirely, doesn't solve the problem. The math doesn't work. Every institution that examines these figures reaches the same conclusion. The Congressional Budget Office acknowledges it in their long-term projections. The Treasury Department understands it. Federal Reserve economists know it. There exists no politically feasible scenario where this debt gets repaid through traditional means. Which leaves one option: devaluation. Make the debt worth less by making the currency it's denominated in worth less. But here's the challenge. If the government simply prints money to pay obligations, inflation becomes obvious, confidence collapses, and the dollar crashes in a disorderly way that destroys government credibility. They need a more sophisticated mechanism, something that appears responsible, something that looks like sound fiscal policy rather than monetary desperation, something that transfers wealth without appearing to steal it. Enter the strategic reserve strategy. Now we arrive at the executive order from January 2025. The official framing positions this as America maintaining leadership in digital assets, ensuring the United States doesn't fall behind China or other nations adopting cryptocurrency, protecting American innovation in blockchain technology. These rationales sound plausible to anyone not examining the underlying financial architecture. But step back and analyze what's actually being constructed. The government currently holds approximately 210,000 Bitcoin accumulated through seizures from criminal operations, Silk Road, Bitfinex hacks, various ransomware investigations. At current market prices, which have been volatile, trading around $95,000 to $100,000 per coin after peaking, above $126,000 in October 2025. That represents roughly $20 to $21 billion in digital assets. Meaningful, but nowhere near sufficient to address a $38 trillion debt problem. The executive order doesn't stop at holding existing Bitcoin. It authorizes active acquisition. Senator Cynthia Lummis, who introduced the Bitcoin Act in December 2024, proposes a target of 1 million Bitcoin accumulated over 5 years. At today's prices, purchasing that quantity on open markets would cost approximately $95 to $100 billion. A staggering sum that would spike prices and telegraph government intentions. So they're not buying through market orders. They're accumulating through alternative channels that don't create price pressure or public awareness. Seizures from ongoing investigations. Every major cryptocurrency-related criminal case generates asset forfeitures. These coins transfer to government wallets automatically through legal proceedings. Penalty settlements. Cryptocurrency companies facing regulatory enforcement can settle violations by transferring Bitcoin directly to government reserves rather than paying fines in dollars. Mining operations, using government-controlled energy infrastructure, particularly excess capacity from federal power projects, to mine Bitcoin directly. This generates new coins without market purchases. Covert acquisition through intermediaries, purchasing through shell entities and foreign exchanges in ways that don't show up as U.S. government buying, preventing market front-running. The accumulation happens quietly, without announcements, without drawing attention. Because the strategy isn't to buy Bitcoin at current prices. The strategy is to accumulate Bitcoin before revaluing it. Here's how the revaluation mechanism would function. Over the next 3 years, the government quietly accumulates 1 million Bitcoin at an average cost of roughly $120,000 per coin through the methods described above. Total acquisition cost, $120 billion. The market doesn't know the full extent of government holdings. Official disclosures remain vague. Then comes the announcement. Probably timed during a debt ceiling crisis or market turmoil when extraordinary measures seem justified. The Treasury declares that the strategic Bitcoin reserve is fully operational. We hold 1 million Bitcoin and, for purposes of federal balance sheets and strategic reserve valuation, Bitcoin will be marked at $1 million per coin, not the current market price of $95,000 to $100,000, not a modest premium. $1 million per coin, a tenfold increase through administrative decree. This creates an instant balance sheet effect. The 1 million Bitcoin acquired for $120 billion is now officially valued at $1 trillion on government books. The government has manufactured $880 billion in paper wealth through revaluation. No economic activity occurred. No value was created. But the balance sheet shows a $1 trillion asset where $120 billion existed before. Now watch what happens in markets. When the United States government, the largest holder of Bitcoin globally, declares that Bitcoin is worth $1 million for official purposes, backed by the full faith and credit of the federal government, market participants take notice. The government has effectively established a price floor. Bitcoin doesn't reach $1 million overnight, but it begins climbing, from 100,000 to 300,000, over several months as the market digests the news, then to 500,000 as momentum builds, then 800,000 as speculative buying intensifies. Within 12 to 18 months, the market price approaches the government's official valuation, close enough that the Treasury's accounting appears justified. But here's the critical insight that most people will miss. While Bitcoin is rising from 100,000 to $1 million, what's happening to the dollar? It's collapsing. Because if Bitcoin, a digital asset with no industrial use, no dividend, no intrinsic value beyond network consensus, suddenly requires 10 times more dollars to purchase, it means each dollar has become worth proportionally less. The revaluation of Bitcoin upward and the devaluation of the dollar downward are the same event viewed from different perspectives. The government isn't making Bitcoin more valuable, they're making the dollar less valuable, and everyone holding dollars, bonds, or dollar-denominated assets watches their purchasing power evaporate. Bitcoin alone won't suffice. The strategy requires a second pillar, one with thousands of years of monetary history providing legitimacy. That pillar is gold. The United States officially holds 8,133 metric tons of gold, equal to approximately 261 million ounces. At current market prices around $4,000 per ounce, gold has surged approximately 45% in 2025 alone. Validating the flight to hard assets, these reserves are worth approximately $1.05 trillion. Substantial and growing, but still insufficient to significantly offset $38 trillion in debt. But here's where the accounting becomes fascinating. That gold isn't valued on government books at $4,000 per ounce. It isn't even marked at current market prices. The official statutory price, set in 1973 and never updated, stands at $42.22 per ounce. Yes, you read that correctly. The government holds an asset worth $1.05 trillion at market prices, but values it on official books at just $11 billion. Why maintain such an absurd discrepancy? Because it creates enormous latitude for revaluation. Watch how this plays out. The government announces a new gold policy, framed as returning to sound money principles and strengthening the dollar's foundation. They declare that for purposes of strategic reserve backing and federal balance sheet accounting, gold will be revalued to $20,000 per ounce. Why $20,000 specifically? Because that's the number that makes the debt mathematics work. At $20,000 per ounce, the 261 million ounces held by the U.S. government become worth $5.2 trillion. That's $5.2 trillion in newly created balance sheet value, simply by changing the official price. The government announces this isn't speculation or market manipulation, it's responsible fiscal policy. They're recognizing gold's true strategic value. They're backing the dollar with real assets. They're restoring monetary credibility. The language sounds conservative, almost traditional, like returning to time-tested principles that our grandparents would have understood. But the reality underneath that rhetoric is simple. They're devaluing the currency by 500% relative to gold's current price, or 700% relative to where it was just a year ago. Now combine both strategies. 1 million Bitcoin at $1 million per coin creates $1 trillion in balance sheet value. 261 million ounces of gold at $20,000 per ounce creates $5.2 trillion in value. Total newly created paper wealth, $6.2 trillion. That's $6.2 trillion in assets that can technically offset debt on government balance sheets, making the debt-to-GDP ratio appear more manageable, making the financial position look stronger, creating the illusion of solvency. Not actual solvency, the debt hasn't been paid, but balance sheet solvency, which is what matters for maintaining confidence in government securities. And once gold is officially marked at $20,000 per ounce by the world's largest gold holder, market prices follow. Not immediately to $20,000, that would take time, but gold begins climbing from $4,000 to $7,000, then $10,000, then $15,000 over subsequent years. The official valuation creates a gravitational pull on market prices. Here's what this means for your wallet. If gold rises from $4,000 to $20,000, your dollar has lost 80% of its value measured against gold. If Bitcoin rises from $100,000 to $1 million, your dollar has lost 90% of its value measured against Bitcoin. The average person doesn't think in terms of gold or Bitcoin. They think in terms of groceries, rent, and gas. But when the dollar loses 80 to 90% of its value against hard assets, it loses 50 to 70% of its value against everything else. Food prices don't merely rise, they double or triple. Energy costs quadruple. Housing costs explode in nominal terms while becoming less affordable in real terms because incomes don't keep pace. The purchasing power of your savings, your salary, your retirement account, all of it evaporates through inflation. That most people won't understand is actually currency devaluation by design. Let's make this concrete with a scenario. You're a prudent saver with $100,000 in your bank account. You've worked for decades to accumulate this cushion. You think you're secure, not wealthy, but comfortable enough to weather emergencies. Then the revaluation happens. Gold goes to $20,000 per ounce. Bitcoin approaches $1 million. The dollar begins its collapse. Over the following 3 years, real inflation, not the manipulated consumer price index, but actual cost of living increases, runs at 20% annually. Your grocery bill doubles. Gasoline prices double. Your landlord raises rent by 60% to keep pace with their costs. Everything you need to survive becomes dramatically more expensive. But your savings account balance doesn't change. It still shows $100,000. Except those $100,000 now purchase what $35,000 bought 3 years earlier. You've lost 65% of your purchasing power. Not through stock market crashes you could have avoided. Not through bad investments you could have prevented. Through government policy that deliberately devalued the currency you were forced to use. Meanwhile, the government's debt burden has been erased in real terms. The $38 trillion they owed is still $38 trillion nominally. But adjusted for the inflation they created, it's worth only $13 trillion in real purchasing power. They've eliminated $25 trillion in debt burden without paying a cent. They transferred that wealth from creditors, savers, and dollar holders directly to government balance sheets. Let's be explicit about who wins and who loses in this scenario. Winners, the federal government. $25 trillion in real debt burden eliminated. Politicians, they avoided the electoral consequences of spending cuts or tax increases. The Federal Reserve maintains control over monetary system. Early Bitcoin adopters, if you bought at $30,000 and it goes to $1 million, you preserve wealth and then some. Gold holders, if you bought gold below $2,000 per ounce and it goes to $20,000, you're protected. Wealthy individuals with hard assets, real estate, commodities, businesses, all inflate nominally, preserving real value. Foreign governments holding gold. China, Russia, India, their reserves get revalued too, helping them erase their own debts. Losers, middle-class savers, purchasing power of cash savings destroyed. Retirees on fixed incomes, Social Security and pensions don't keep pace with real inflation. Bondholders, anyone holding Treasury securities gets repaid in devalued dollars, losing 70% in real terms. Pension funds, massive Treasury holdings become worthless in real terms, forcing pension collapses. Workers, wages lag inflation by years, causing real wage declines of 40 to 50%. Renters, landlords raise rents with inflation, but wages don't match, pricing people out of housing. Small businesses can't raise prices fast enough to cover costs, causing mass failures. The wealth gap doesn't just widen, it explodes. The middle class shrinks dramatically. Multi-generational wealth accumulation becomes nearly impossible. The American dream, denominated in a currency that's being deliberately destroyed, dies. Some will argue this is speculative fear-mongering. Let's examine the historical record. What I'm describing isn't theoretical. It's the standard government response to unpayable debt. Consider these examples. Weimar Germany, 1920s, Crushed by World War I reparations they couldn't pay, the German government printed money. The mark collapsed. Hyperinflation destroyed the middle class. People brought wheelbarrows of cash to buy bread, but the government's war debt effectively vanished. It was repaid in worthless currency. Argentina, multiple times, 1980s, 1990s, 2000s, repeatedly unable to service foreign debt, Argentina devalued the peso again and again. Savings evaporated. But government debt burdens became manageable because they were repaid in devalued currency. Zimbabwe 2000s, government spending spiraled out of control. They printed Zimbabwe dollars to cover deficits. Hyperinflation reached incomprehensible levels, billions of percent annually. The currency became literally worthless, but government obligations denominated in Zimbabwe dollars effectively eliminated. Venezuela 2010s, oil revenue collapsed. Rather than cut spending, they printed bolivars. Hyperinflation destroyed the economy. People fled the country. But government debt in bolivars became meaningless. The pattern is universal across geography and time. Government accumulates unpayable debt. Government faces choice between default and devaluation. Government always chooses devaluation. Because default destroys government credibility permanently, you can never borrow again. Devaluation destroys citizen wealth while preserving government power. The choice is obvious from the government's perspective. And the United States is following this exact pattern, just with more sophisticated branding and better public relations. They're not calling it money printing, they're calling it strategic reserve revaluation. They're not calling it currency debasement, they're calling it restoring gold-backed stability. They're not calling it theft, they're calling it necessary fiscal policy to preserve American financial strength. But the outcome is identical to every historical example. Citizens holding the currency lose everything. Government survives. Let me show you the concrete evidence that this strategy is already in motion. December 2024, Senator Cynthia Lummis introduces the Bitcoin Act, proposing the United States acquire 1 million Bitcoin over 5 years, and hold them for at least 20 years as a strategic reserve. This isn't a fringe proposal from an unknown backbencher. Lummis sits on the Banking Committee and has garnered bipartisan support. Why? Because both parties understand the debt is mathematically unpayable and prefer devaluation over spending cuts. Both parties would rather implement hidden taxation through inflation than visible taxation through higher rates. This bill creates the legal framework for Bitcoin accumulation and subsequent revaluation. January 23, 2025, President Trump signs executive order establishing the Strategic Bitcoin Reserve. This isn't campaign rhetoric or future planning. This is implementation. The order grants the Treasury Department authority to acquire and hold Bitcoin. It directs federal agencies to develop supporting policies for digital asset integration. It explicitly positions Bitcoin as a national security matter, which is government code for this, can override normal constraints during emergencies. The executive order is the action phase. The bill was the proposal. The order is execution. They're not waiting for perfect consensus or detailed legislative debate. They're moving now. Increasing gold-backed currency discussion. Pay attention to rhetoric from both political parties about sound money and gold backing. This isn't philosophical debate about monetary theory. It's narrative preparation. They're conditioning the public to accept gold revaluation as responsible fiscal policy. Here's the setup. You can't credibly claim the dollar is backed by gold at current prices. The M2 money supply, basic measure of money in circulation, stands around $21 trillion. U.S. gold holdings are worth $1.05 trillion at current market prices. That's about 5% backing. While better than a year ago when it was only 3.5%, no one takes a gold-backed currency seriously when it's only 5% backed, but revalue gold to $20,000 per ounce. And suddenly, you have $5.2 trillion in gold reserves. That's 25% backing of the money supply. Now you can market this as meaningful gold backing. You can sell it to conservative voters who want hard money. You can position it as fiscal responsibility and sound monetary policy. But what's really happened? You've revalued gold fivefold from current levels and destroyed the dollar's purchasing power by 80%. It's theft marketed as conservative principle. International coordination signals. Watch what's happening globally. The BRICS nations, Brazil, Russia, India, China, South Africa, have been discussing an alternative to dollar dominance for years. They're not just talking, they're accumulating gold aggressively. China officially reports 2,300 tons of gold reserves. Independent analysts estimate the real figure is between 4,000 and 6,000 tons, with the difference held through shell entities to avoid alarming markets. Russia holds 2,336 tons officially and has been adding to reserves systematically for over a decade. India holds 855 tons and continues purchasing, recently buying significant quantities at premium prices. Central bank gold purchases globally exceeded 2,000 tons in both 2022 and 2023, the highest sustained buying since 1950. These institutions have access to economic intelligence you and I can't imagine. They employ thousands of economists. They see modeling decades into the future, and they're all preparing for the same event: a dollar collapse and monetary reset. If governments, with intelligence agencies, economic advisors, and insider information, are preparing for a currency devaluation, why would ordinary citizens assume they're safe holding dollars? Based on policy trajectories, legislative schedules, and debt ceiling deadlines, here's the probable timeline, noting that events in 2025 have already begun validating this scenario. 2025 quiet accumulation phase happening now. The government accumulates Bitcoin through seizures, settlements, and covert purchases. They don't announce running totals. They don't telegraph intentions. The accumulation happens in the shadows of criminal prosecutions and regulatory enforcement actions. Meanwhile, gold reserves remain stable. But look at what the market is doing. Gold has already surged 45% in 2025, signaling that smart money is positioning ahead of the reset. Note that we've already seen the debt ceiling crisis materialize in July 2025, earlier than anticipated. With the limit raised from $36.1 trillion to $41.1 trillion, this accelerated timeline validates the urgency of these warnings. For you, this is the critical window. This is when you must position yourself. Bitcoin is currently around $95,000 to $100,000 after volatile movements. Gold is around $4,000 per ounce. Real estate hasn't yet factored in currency collapse. You can still accumulate protective assets at prices that will look absurdly cheap in hindsight. 2026 crisis escalation phase. Additional debt crises will provide the necessary political cover. Maybe it's another debt ceiling showdown. Maybe it's a bond market revolt where treasury yields spike and buyers disappear. Maybe it's a recession that causes deficit spending to explode even further. The specific trigger matters less than the function, creating emergency conditions that justify extraordinary measures. In normal times, revaluing government assets by 500 to 700% would look like desperate monetary manipulation. During a crisis, it looks like bold leadership saving the nation from disaster. Crisis creates political permission for actions that would otherwise be unthinkable. This is why every major monetary reset in history happens during or immediately after a crisis. It's not coincidence, it's strategy. Markets will be volatile during this phase. 2027 revaluation announcement phase. The government announces the strategic Bitcoin reserve is fully operational. They hold 1 million Bitcoin, acquired at an average cost below $150,000 per coin. For federal balance sheet purposes, Bitcoin is now valued at $1 million per coin. Simultaneously, they announce a return to gold-backed currency principles. The dollar will be partially backed by gold reserves. Gold is revalued to $20,000 per ounce for strategic reserve accounting. This is marketed as strengthening the dollar, restoring fiscal credibility, ensuring American financial leadership in a competitive global environment. The language sounds responsible, conservative, even reassuring. Most Americans will hear these announcements and think the government is fixing problems. But watch what happens next. Bitcoin begins climbing from wherever it stands, likely 120,000 to 150,000 to 150,000 toward 1 million over the following 12 to 18 months. Gold begins climbing from current levels around 4,000 toward 20,000 over the same period. The dollar loses 70 to 80% of its purchasing power against hard assets. Inflation doesn't run at the official 3 to 4%, it explodes to 30 or 40% in the first year. Food prices triple, energy prices quadruple, housing prices double in nominal terms, but become less affordable because wages don't keep pace. The economy enters stagflation. High inflation combined with low or negative growth Unemployment rises to 8 or 10% as businesses fail. The middle class is hollowed out. But the debt, that $38 trillion in nominal terms, becomes worth roughly $12 to $13 trillion in real purchasing power. $25 trillion in real debt burden eliminated. Mission accomplished from the government's perspective. 202-82030, stabilization at new reality phase, the prices stabilize. But at the new, dramatically higher levels, Bitcoin settles somewhere between $500,000 and $800,000 below the official $1 million revaluation, but high enough to validate the government's balance sheet accounting. Gold stabilizes between $15,000 and $18,000 per ounce. The dollar has stabilized, but at a purchasing power 70% below where it started. Those who held hard assets through the transition, those who held dollars, lost 70%. The wealth gap has exploded. The middle class has shrunk dramatically. Multi-generational wealth building has become nearly impossible for ordinary workers. A new normal establishes itself, one where the American middle-class standard of living has permanently declined. I'm not telling you this to create panic. I'm telling you this so you can position yourself correctly before the window closes. Here's your action plan. Step 1. Exit dollar-denominated long-duration assets. Bonds are the single most dangerous asset class right now, whether government bonds, corporate bonds, or municipal bonds. If they're denominated in dollars and have long maturities, they will lose 70% of their value in real terms. Sell them now. Don't wait for the perfect timing. The risk of staying in bonds far exceeds any potential upside. Excess cash is similarly dangerous. Calculate 3 months of living expenses. Keep that amount in checking or savings for operational liquidity. Everything else needs to move into protective assets. Cash sitting in savings accounts is being silently destroyed through negative real interest rates, even before the crisis hits. Step 2. Enter hard assets. Systematically physical gold should be your foundation, not gold ETFs that might have counterparty risk, not gold mining stocks that could be nationalized. Physical gold coins and bars that you control, stored securely. Target 10 to 20% of your net worth in physical gold as insurance against currency collapse. Yes, gold has already risen to $4,000 per ounce, but this is still cheap relative to the $20,000 revaluation target. Bitcoin is higher risk, but higher reward. If you understand the technology and can secure it properly, hardware wallets, proper key management, allocate 5 to 15% of net worth here. Bitcoin is more volatile than gold, as we've seen with recent fluctuations between $95,000 and $126,000. But the government is about to revalue it to $1 million. That creates asymmetric upside. Real estate, particularly income-producing property, provides inflation protection. Farmland, rental properties in strong markets, commercial real estate with solid tenants, these assets rise nominally with inflation while generating income. Avoid speculative flips or vacation homes. Focus on productive real estate. Commodities exposure through broad commodity funds or direct investment provides diversification. Energy, agriculture, industrial metals, all will rise as currency devalues. You're not speculating on specific commodity prices, you're protecting against currency decline. Step 3. Handle debt strategically. This seems counterintuitive. If the dollar is being devalued, shouldn't debt be good? You're repaying in cheaper currency, right? In theory, yes. In practice, the math usually doesn't work for individuals. Your debt is denominated in dollars, but your income is also denominated in dollars. When currency devalues, wages typically lag inflation by years. So even though you're technically repaying with cheaper dollars, you're earning fewer real dollars. Unless you're the government with the power to tax or print money, debt becomes a trap during hyperinflation. Eliminate high-interest debt immediately. Credit cards, personal loans, auto loans. These rates will eat you alive during stagflation, when earning power is compressed. Fixed-rate mortgages below 4% are the exception. If you locked in a 3 or 3.5% mortgage when rates were low, keep it. That debt will inflate away while your payment stays fixed. But adjustable-rate mortgages or high fixed rates above 6% should be paid off or refinanced if possible. Step 4. Diversify internationally. Don't keep all wealth denominated in dollars within U.S. jurisdiction. Open accounts in foreign banks holding currencies from countries with lower debt levels. Swiss francs, Singapore dollars, Norwegian kroner. These aren't perfect. All fiat currencies face devaluation risk, but they're better positioned than the dollar. Consider foreign real estate in countries that aren't destroying their currencies. Property in Switzerland, New Zealand, or Norway provides geographic diversification and exposure to more stable monetary systems. International stocks, particularly companies earning revenue in non-dollar currencies, provide another hedge. You're not trying to pick winning companies. You're trying to have wealth spread across multiple currencies and jurisdictions. Step 5. Build skills and community. Fix when currencies collapse. What ultimately matters is what you can produce and who you know. Skills that generate value regardless of currency, medical knowledge, repair skills, agricultural expertise, essential trades, relationships with people who have resources, land, tools, food supplies, specialized knowledge. This sounds extreme, like survivalist prepping. But history shows that currency collapse creates social instability. Having practical skills and strong community ties isn't paranoia, it's insurance. The person who can fix plumbing, grow food, or provide medical care will maintain living standards regardless of currency value. You're probably thinking this sounds too extreme, too conspiratorial, too much like financial doomsaying. Let me show you why it's not. The debt-to-GDP ratio of 123 to 125% is public data, not speculation. Fact, the annual interest payment approaching $1 trillion, $970 billion in fiscal 2025, is public data, not projection. Current reality, the mathematical impossibility of repaying this through conventional means, isn't opinion, it's arithmetic. Show me the scenario where this debt gets paid without devaluation. The numbers don't exist. Devaluation as government policy isn't conspiracy theory, it's historical precedent. The United States did this in 1933. We're watching the same playbook with updated branding. The executive orders and legislative proposals aren't secret, they're public record. The Bitcoin Act was introduced in December 2024. The executive order was signed January 23, 2025. These are visible policy moves happening in real time. Central bank gold buying at record levels isn't speculation. It's reported data from the World Gold Council. Over 2,000 tons purchased annually in 2022 and 2023. These are institutions with resources and intelligence far beyond what individual investors possess. And they're all preparing for the same outcome. And look at what's already happening. Gold has surged 45% in 2025. The debt ceiling crisis hit in July 2025, earlier than expected. Bitcoin peaked above $126,000 before correcting. These aren't random events. They're confirmations that the reset mechanism is already in motion. This isn't conspiracy, this is policy, visible policy. The only question is whether you'll recognize it and position accordingly, or whether you'll trust government assurances until it's too late. Let me address the fairness question directly, because I know what you're thinking. This isn't fair. You're right, it's not fair, it's theft. Legally authorized, bureaucratically executed, economically sophisticated theft, but it's still theft. You can be morally outraged and financially destroyed, or you can be morally aware and financially positioned. I strongly recommend the latter. The government doesn't care about your moral objections. They care about their institutional survival, and they will sacrifice your purchasing power without hesitation, without guilt, without apology. That's not cynicism, that's reality. Power protects itself first. Citizens are collateral damage. This has been true throughout human history, and it's true now. So you face a choice: adapt to the reality, or be destroyed by refusing to acknowledge it. Position yourself in hard assets. Preserve wealth through the transition. Use that preserved wealth to build something better on the other side. Or, alternatively, hold dollars, trust government narratives, believe they're protecting your interests, and watch your life savings evaporate over the next 3 years. I know which choice I'm making. I know which choice informed investors globally are making. The only question is which choice you'll make. Here's your week-by-week action plan. Week 1. Open a precious metals dealer account. Purchase minimum 1 ounce of physical gold. Yes, at $4,000 per ounce. This is a significant investment, but it's still 80% below the projected revaluation price. Scale based on net worth, targeting 10 to 20% allocation. Week 2. Open a Bitcoin exchange account and a hardware wallet. Purchase minimum $1,000 worth of Bitcoin if possible, at current prices around $95,000 to $100,000 per coin. This gets you approximately 0.01 Bitcoin. Scale based on risk tolerance, targeting 5 to 15% allocation. Week 3. Review all bond holdings. Sell long-duration government and corporate bonds. Move proceeds to hard assets or money market funds as temporary holding. Week 4. Audit cash holdings. Reduce to 3 months of expenses. Deploy excess cash into protective assets. Month 2. Research international diversification. Open foreign bank account. Investigate international real estate or stock exposure. Month 3. Inventory your skills. What can you do that creates value? Connect with local community networks. Consider practical skill development. This timeline is aggressive because the window is closing faster than originally anticipated. The accumulation phase is happening now. The crisis phase has already begun, with the July 2025 debt ceiling increase to $41.1 trillion. The revaluation is probably 2027 or sooner. You have maybe 12 to 24 months to position yourself before the mechanism fully activates. Once revaluation happens, it's too late. You can't buy hard assets after they've already exploded in price. You can't protect purchasing power after currency has already collapsed. The time to act is when it feels too early, when it feels uncomfortable, when it feels like maybe nothing will happen, because by the time it's obvious to everyone, the protection has become unaffordable. The 2027 reset is coming, possibly sooner. The U.S. government will use Bitcoin and gold revaluation to erase $38 trillion in debt. They'll do it by devaluing your dollars, your bonds, your savings. It's already in motion. The executive orders are signed. The legislative framework exists. The accumulation is happening. Gold has already begun repricing upward. The debt ceiling has already been breached and raised. Your choice now is simple. Position yourself correctly while there's still time. Or trust that somehow this time will be different, despite all historical evidence suggesting it won't be. The choice is yours. But choose quickly. The window is closing faster than expected.